Welcome back to Bazaar Morning Call. It's that time of the day when we have our first guest to understand the micros. And today there are lots of stocks to discuss. Joining us now is Amnish Aggarwal. Amnish, good morning and thank you very much. But before I shoot my first question to you, can we just get the key details of the Reserve Bank's Financial Stability Report, because that is going to be our first question. They released what is called the FSR last evening, and that is giving us some warning about unsecured loans. So let me just listen in to my colleague Ritu Singh, who filed the story.
I'll start with some of the key risk areas that RBI has flagged off in the Financial Stability Report, starting with the retail loan segment, where RBI points out that while the retail segment gross NPAs at 1.2% are stable so far, the bad loans in the unsecured segment are higher at 1.7%, with more than half of retail loan slippages across the system coming from the unsecured segment. But what's more concerning, says RBI, is the sharp rise in retail loan write-offs, particularly by private sector banks, which could be masking deeper issues like bad asset quality and weaker underwriting standards. Microfinance is another area under strain. Stress assets, those overdue between 31 and 180 days, more than doubled in just 6 months, rising to 4.3% as of September. And borrower indebtedness is also climbing. RBI says nearly 6% of borrowers now have loans from 4 or more lenders at a time, compared to just 3.6% 3 years ago. And loan sizes have also ballooned, up 43% in the last 3 years on average. In consumer credit, the report says around half of credit card and personal loan borrowers are juggling another high-ticket loan. So smaller personal loans are putting secured loans, which are larger as well, at risk, because keep in mind, a default in any loan category results in the loans of the same borrower being treated as an NPA as well. Now, if we look at RBI's stress test results, which are not projections but rather outcomes that are based on hypothetical stress scenarios, they suggest gross NPAs could more than double from 2.6% as of September to 5.3% by March of 2026 in the worst case adverse scenario, with public sector banks remaining most vulnerable. But even in the base case, RBI says NPAs are expected to rise in the coming year as per the stress test. Now, capital adequacy remains resilient at 16.6%, but it could drop all the way to 14.3% under one of the stress test scenarios. As for NBFCs, a stress test showed that gross NPAs could rise sharply from 2.9% to 6% under high risk, while capital adequacy could fall to 20.2%. Alarmingly, 15 NBFCs could fail to meet the minimum capital adequacy ratio if severe risks materialize. So overall, the report paints a mixed picture. The system shows resilience on one hand, but on the other, vulnerabilities are emerging across retail, microfinance and consumer credit.
That was Ritu Singh, who filed the story yesterday. Amnish, the latter part of what Ritu is saying is only if there is stress, if something happens globally. But in the earlier part, as Ritu delineated, RBI seems to be worrying about a higher leverage, more people having 4 loans per head, and the size also ballooning by 43%. Any worries? How would you approach the banking and NBFC sector?
Yeah, hi Lata. You see, these some of the things which have been highlighted. They are not, I would say, entirely new. Well, if you look at, say, last couple of years in particular, there have been news from time to time that the unsecured lending in particular can come under pressure. And that is exactly what this report is highlighting. Now, the second part is on the microfinance loan. If you look at all the MFI and the related, whether it is an IndusInd Bank or some of the standalone MFIs. So I think they are actually witnessing sharp increase in the NPAs in the last, say, few months. So I think a lot of it is already there. But having said that, the kind of, pressure which is currently being witnessed with many of the consumers more at the low to lower middle end having multiple loans and all, I think that is something which is a reality. And I think it is going to play out over the next, say, couple of quarters. Now, having said that, my sense is that maybe you can say this quarter and at maximum couple of quarters more, the inflow of the worst news that would be over. So in terms of stock price, if you look at all the segments most of these stocks in these segments, whether these are, you can say, the banks related to that or some of these MFIs, I think they have either bottomed out or they may be close to bottoming out in the next, say, 3 or 4 months. So I would say in certain segments, the growth rates have come off. Say, for example, whether it is, you can say, NBFCs, which are focused on commercial vehicles. So the growth rates might remain nimble for some time, but a lot of these negative news might have already been factored into the stock price of stock companies.
Amnish, hi. ITC Hotels, that's going to be the talking point. The development overnight is that the record date has now been announced, which is 6th of Jan. Now, just for our viewers to put on board the numbers of ITC versus CN Indian Hotels. Now, ITC's revenues in FY24 were about 3,100 crore rupees, while Indian Hotels was 6,700 crore rupees, so less than half its size. And margins for the two are comparable at close to about 32-34% roughly. So margins are comparable. But ITC Hotels, Amnish, has set a fairly ambitious target. They have 140 hotels currently, and I think they have indicated that by 2030, they would like to have 200 hotels. From 140, they want to make it 200 hotels by 2030. Have you done the analysis of ITC Hotels? What would be the appropriate value? And between Indian Hotels and now potentially ITC Hotels, which one should retail shareholders look at?
Okay, hi. You see, when it comes to ITC Hotels, it's the second largest chain in the country. Now, we have been valuing this company as a part of ITC Limited, where we have assigned a value of, say, roughly around 27, 28 rupees per share. Or you can presume anywhere between 25 to 30 rupees per share is the value which comes for the ITC shareholders. Now, if you then translate into the standalone, you can say entity, which would be having close to, say, I think some 125, 126 crore shares. So that should translate to something like, you can say 200 to 220 to 230 rupees per share. But I think once this company is listed separately, then I think that the dynamics would be different, and I think it could command a reasonably good valuations because the size is there, the profitability is there, and they will also be giving it enough cash to grow for the next few years. And the hotel industry currently is doing well. Your ARRs are moving up, the occupancies are good. So, and I think that given the state in which the hotel industry is currently, I think the listing of the ITC should be good and it should really unlock value for shareholders.
The company said that they'll be transferring 1,500 crore of cash from ITC to ITC Hotels to begin with.
Yeah, so, Amnish, since you have now a formidable competitor for Indian Hotels, would you, chip off something from Indian Hotels, reduce your positions or at least reduce your price targets?
I don't think it's going to play out like that because the ITC Hotels was always a very formidable competitor when it comes to business. But when it comes to, you can say, now the only difference is that it will be a separately listed company. Now, when it's a listed company, actually it gives a more option to the investors. Because if you look at all the hotel companies which are listed, for example, your EIH is there, ITC is there, and then the host of, you can say, mid-cap names are there. So to that extent, I think the second largest company getting listed separately is positive. Now, I don't think that necessarily there would be, you can say, something which would, yes, there will be, I would say, renewed interest as far as the ITC stock of the hotel is concerned. However, having said that, I don't rule out that few months down the line, or when I think at the earliest possible opportunity, your BAT will come and try to sell their holding in ITC, because ITC Hotels is being demerged as a, you can say, mirror image of ITC Limited. Okay, and BAT would be having roughly around, say, if you look at, say, 60%, 25% of that, around, say, roughly around 15% of holding will be with BAT, and I think BAT would be looking at exiting this company sooner or later. So I think that will actually also provide a very good base for the institutions to take or increase the shareholding in ITC. But nonetheless, I think it is going to be quite interesting. And the way the hotel industry is, I think, doing at present, ITC Hotels will provide another opportunity for the investors to participate in the growth in this industry.
You know, the kind of wealth Indian Hotels has created, 100% in 2024 and 400% in the last 3 years. So the hospitality sector in India has really taken off post-COVID.
Amnish Aggarwal is still with us. Amnish, there are two stocks in the news which we desperately want to ask you. One is Adani Enterprises moving out of Adani Wilmar. Does that make any of them attractive to you? And the other one is Easy My Trip, if you are looking at that stock.
Okay, see, is my trip, I don't have, you can say, much hang on. As far as your Adani Wilmar and Adani Enterprise is concerned, I think in a way it is positive for both the companies. If you look at, say, Adani Enterprise, then actually they will get an inflow of close to $2 billion, which I think could be very handy for them because they are incubating a lot of new businesses. They are entering into a lot of segments. And I think a lot of, you can say, lot of requirements of funding the capex will be taken care of by that, at least in the near term. So that is definitely a positive. Now, when it comes to Adani Wilmar, you see, the main thing is that Adani Group is going more on the, I would say, if you look at their forays, it's more on, you can say, they are into ports, they are into power, and they are into reality and various other infrastructure segments. So Adani Wilmar was the only, you can say, JV which was on the consumer side, and that too in the more commoditized segments where the margin trajectory as such is low. Now with Wilmar, which is actually, you can say, Asia-based MNC taking it over, I think the focus will be slightly more in any which ways, as per our understanding, most of the operations they were being undertaken by Wilmar only. So that I think that focus will also come on that. I think over a period of time, I think it's a win-win situation for both the companies actually.
Just in the near term, Wilmar will face a supply overhang as one of the promoters looks to sell that 13% stake to bring it down to 75%. So there will be that supply overhang. But Amnish, thank you very much for joining us today and wish you a very, very happy new year. Look forward to chatting with you more often in 2025.